All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. Hi there. My name is Alex Mason and I am your host. And let's go ahead and get into today's question because this is a little bit of a longer accounting question. So the question is this: let's say a company purchases a factory for $100 using debt. How are the three financial statements affected, both at the beginning of the purchase, after a year, after another year, and then let's say that in the third year the factory breaks down and you have to write off the whole thing. So map out the financial statements under those scenarios. So let's go ahead and work through this problem and let's see how it goes. Let's go to the whiteboard. Okay, so we're going to draw out our three financial statements: income statement, cash flow statement, and balance sheet. All right, so we're going to purchase this factory for $100 using debt. So we got our assets, liabilities, and our equity. Okay, so in the first year, nothing happens here on the income statement. Nothing's going on because there wasn't any interest paid, there's no depreciation, you're just purchasing the asset itself. But in the cash flow statement, remember we have three sections here that are important: cash flow from operations, cash flow from investing, and cash flow from financing. So in this scenario, the company is using $100 in order to purchase a factory. So the cash flow from operations isn't really impacted at all because nothing was really sold here. But cash flow from investing is impacted because you purchased this long-term asset. So you're going to be down $100. Now, cash flow from financing is also affected because $100 of debt was raised in order to make this purchase. So this is going to go up by $100 because remember, this is money coming into the company. The company is raising debt in order to make this purchase here for the cash flow from investing. So the net cash position here is actually unchanged, but the assets still change here on the balance sheet because the company gets this new factory. So the company gets a factory that's worth $100, and the liabilities also increased by $100 because the debt was taken out in order to fund it. So factory goes up $100, your debt goes up $100, and then subsequently there's no change in equity here and your balance sheet balances. So this is at year zero. This is time zero. Okay, so at the beginning of year two, which you could also think of as the end of year one, we're going to have to account for some different things going on here. So let's go ahead and assume that there's 10% depreciation on the factory per year. And let's also assume that there's, or I should say $10 of depreciation per year. Let's also assume that there's 10% interest on this loan that's taken out. And we're also going to assume that no principal is paid down. The high yield loan where interest is being paid. So over here on the income statement, you got your revenue, cost of goods sold, other expenses. Now depreciation is going to be within these expenses. And so our operating profit is going to go down by $10. Now, this is before interest and taxes. So we've accounted for depreciation throughout this first year. Let's now account for the interest. So we're also going to assume that there's an interest expense and 10% of the $100 of debt is going to be $10. So now our pre-tax income is down by $20. If we assume a tax rate of 40%, that's going to take down our net income. So let's say we have taxes of 40%. 40% of 20 is 8. So we're down $12 in net income. That's what would happen if we account for these depreciation expenses as well as the interest expenses as well. So we bring this net income number all the way up to our cash flow from operations. So net income is down by $12. And remember, we have to add back depreciation expenses because that's a non-cash expense. So depreciation we said was 10. So we're going to add this back. Operating cash flow is down by $2. Okay, so there's no change in our cash flow from investing. We didn't buy or sell any business assets. We also didn't pay off any principal or raise any more debt. So these portions of the cash flow statement remain unchanged. So our net change in cash flow is going to be down by $2. And remember, this flows up to our assets. So our cash is down by $2. And then remember our $100 factory, because we just took a $10 depreciation charge, the factory is now only worth $90. So the factory value of the factory is down by $10. And then we're assuming no change to the debt burden, so that liability would stay the same. So our assets are going down by $12, no change in liabilities, and then our net income, remember, has to flow over to retained earnings. So retained earnings are also down by $12. So because we have our assets changing the same amount and direction as our equity, and there's no change in our liabilities, the balance sheet balances. And so that's what would happen at the end of year 1, beginning of year 2, assuming the depreciation and interest expense assumptions that we just went through. Okay, stick with me. I know this is a lot, especially if you're new to this, but it'll become more intuitive over time, I promise you. You just keep practicing this. So let's go ahead and talk about what happens if we write everything off. Okay, now we're assuming that in year 3, the factory is going to be written off completely. And so we want to see how that affects the different statements. So first of all, if you write off the factory and there's another year of depreciation, that means the factory is worth $80 because you start out at $100, then it's worth $90, and then after another year it's worth $80. So if you go ahead and sell that factory, you're going to make that $80. Okay, so now in year 3, we're going to say that the factory is completely written off. We're saying it's totally worthless now. We're going to completely take off the value of that asset. So we have our revenue, we have our COGS, and we have our operating expenses. And we're saying that the factory is totally worth nothing now, but it's been depreciated already. So we bought it for 100. After 1 year, it got depreciated down to 90. After the second year, it got depreciated down to 80. So your operating profit is going to go down by $80 because you're writing off the value of this entire factory at that point in time. Now, if we assume a tax rate of 40%, so let's see, 10% of 80 is 8, 8 times 4 is 32. So your taxes are going to be $32. So your net income is going to go down by $48. So that's your change in net income if you're writing off the factory. Our net income then flows up here to the top of the cash flow statement. So net income is down by 48. Now we wrote off the entire value of this factory, which is a non-cash charge. So we're going to add back this write-off. and that is $80. So our operating cash flow is actually up by $32. Now, cash flow from investing, we're going to go ahead and skip that because it doesn't get affected here. But we are assuming we're paying the loan off in its entirety. So because we're going to do that, we're going to pay off the full $100. So cash flow from investing, so debt payoff. Down $100. Okay, so the net change in cash, if we go up by $32 in our cash flow from operations, down $100 in terms of our debt payoff, cash flow from financing, then the net change in cash is $68 net change in cash leaving the company. And so if there's 68 net change in cash leaving the company, that flows up to our assets. Our cash goes down by $68. And then remember our factory, which was worth $80, we're assuming it's worth nothing now, so our factory goes down as well. Factory goes down by $80. So now that means your total assets goes down by $148. Now looking at the liability segment, that also goes down because the debt has now been eliminated. So the debt goes down by a full $100. Okay, so this is how the balance sheet balances. Net income flows to retained earnings. And because net income is down $48, everything balances. Because you see here, your assets, 148, is equal to your debt change plus your change in equity. So 148 equals 100 plus 48. Balance sheet balances, and that's how you solve the problem. Now this is a really long one, and it's going to take some practice to go through those things year after year and see how things like depreciation, interest, write-downs, how all of that affects the three financial statements, but it's super important to understand them because these are like things that can happen in real life and you want to understand how the financial statements are affected. Okay, that's what we got for you today. Here on Investment Banking Insights, my name is Alex Mason, your host, and I'll see you on the next one. All right, take care.